Hello everyone, this is Tom Fox and I'd like to welcome you to episode 263, the Profit Disgorgement podcast on the FCPA Compliance and Ethics Report. The FCPA Compliance and Ethics Report is sponsored by the Red Flag Group. The Red Flag Group is a business advisory, information services, and technology firm that helps clients manage risks across 4 key risk areas. These risk areas include sales and sales channels, including distributors, resellers, and partners, suppliers, customers, and human capital. Human capital, of course, includes employees and contractors. You can find out more information on the Red Flag Group at its website, www.redflaggroup.com. In today's episode, I have 2 very interesting guests, Marc Bohn and George Hani, lawyers at Miller Chevailer, and they have written and thought about some recent issues around profit disgorgement. These issues include the Graham decision out of the 11th Circuit Court of Appeals that limited profit disgorgement, basically going back to the 5-year statute of limitations applicable to SEC civil actions under the FCPA. And then George and his tax team led production of a client alert entitled Disgorgement of Profits in FCPA Cases, Deductions for Tax Purposes, where the IRS disallowed a deduction the company took for profit disgorgement money they paid to the SEC to resolve an FCPA case. The episode comes in a little bit longer today because we had a lot to talk about, but I think you'll find the discussion very enlightening. It adds a level of complexity to the resolution of any FCPA case that really demonstrates you need very good both internal investigation counsel, but also counsel who can sit across from the government and work through the issues involved. I hope you enjoy the episode. Thank you very much for listening to this episode of the FCPA Compliance and Ethics Report. Hello, everyone. This is Tom Fox. I'd like to welcome you to this episode of the FCPA Compliance and Ethics Report. Today, you are in for a real treat because I have 2 lawyers from Miller and Chevailer, Marc Bohn, my colleague on the FCPA blog, a fellow contributing editor and a well-known thought leader in the FCPA area. And we also have the chair of Miller's tax department, George Hani, who is a partner in the firm, and he is going to talk to us about a recent IRS, I'm not quite sure if it's a ruling or a memorandum, but IRS pronouncement on whether disgorgements of profits in FCPA cases are deductible for tax purposes. This is hugely important in the FCPA arena because in the last 3 years alone, the SEC has extracted more than $940 million from companies in FCPA-related dispositions. And of that, approximately $829 million has been through profit disgorgement. The remaining $59 million came through civil fines and another $53 million through prejudgment interest. So this is a huge mechanism by which the SEC extracts fines and penalties. And the IRS issued something called a chief counsel advice. And George, most of my listeners either are compliance practitioners or perhaps sit in the general counsel's office or are lawyers and may not understand what that is. Could you explain what that is and how the service goes through releasing one?
Yes, certainly, Tom, and thank you for the kind introduction. The document that was released, and it was released through the Freedom of Information Act. There is a tax reporting service that just has a standing request to the government that they release various forms of guidance. And this is among the lower forms of guidance in terms of formality, and it has no precedential impact. So it's not a ruling of the service, writ large. The IRS is a big organization. This is guidance that was given by particular lawyers, relatively senior, within the IRS national office to people in the field, IRS auditors in the field, where the field has said, we're looking at a particular taxpayer and we have these legal questions for you, national office. We'll tell you what the facts are and you give us, some guidance for us to deal with in our audit. So the document gets released publicly because it's a statement from the national office. It's redacted so to hide all taxpayer-specific information. So sometimes it's not entirely clear what the facts are, because they refer to dollar amounts as, dollar B, or countries as just country A, country B. But you can see the full, at least the legal analysis. Then applying that analysis to the facts can sometimes be a little mysterious. And do you want me to get into now the substance of the CCA?
Yes, please.
Okay, sure. And in this particular context, the IRS was auditing a taxpayer who had been under investigation and had an enforcement proceeding involving alleged FCPA violations, and entered into an agreement where it paid certain amounts for various items. The key to all of this is what falls under the umbrella of fines and penalties. And we like to have as many things fall outside that umbrella rather than under that umbrella, because if it's considered a fine or a penalty, then it's non-deductible under the tax code. It's section 162F, which prohibits, for public policy reasons, any deduction for any amount that is considered a fine or penalty paid to the government. So when you're confronted with these situations, oftentimes what people do is, the general analysis is to look at the amount paid and try to differentiate between those amounts that are compensatory, sort of reimbursing those who were harmed by the alleged wrongdoing, from amounts that are punitive. And if it falls into the punitive bucket, then it's non-deductible. If it falls into the compensatory bucket, restitution, similar concepts, then it will be deductible. In this context, there was a disgorgement amount, or an amount labeled as disgorgement, and the national office went through an analysis to figure out whether this was primarily punitive or primarily compensatory. It's a very facts and circumstances inquiry. It's going to look at not only the alleged conduct that occurred, as well as the authority of the government to impose the disgorgement or other sanction, and then what happened with the resolution. How did the parties view, particularly how did the government view what the payment was intended to achieve? So in this context, they reviewed the underlying documentation submitted by the exam team, and came to a conclusion that disgorgement was punitive, and primarily because it didn't reference any compensation to any other person. It's interesting in particular because in the analysis, it quotes quite extensively from one particular case. And in that case, it refers to disgorgement as an equitable remedy that is not punitive. Nonetheless, the CCA still concludes that disgorgement in that context was punitive. So it sort of raises in my mind, when you go through this analysis about something as being primarily punitive or primarily compensatory, does disgorgement now create sort of a third category, that if it's compensatory, then it is deductible. If it's punitive, it's not deductible. But is disgorgement now somehow in a third category as an equitable remedy?
George, if I could stop you there and bring in Marc, because Marc has written and thought and truly been a thought leader in the area of equitable remedies in the FCPA. And Marc, let me pose this to you, because thinking back to some vague times when I actually took equity in law school, as I recall, an equitable remedy was not punitive in nature. It was there to do justice or to do equity, and to put the parties back in the position where they may have been when the conduct began. Is that kind of, have I got that wrong, or is that different from what your research shows you?
I mean, my understanding of it is the same. One thing to note is that the statutory basis for disgorgement doesn't technically reference equity and doesn't technically define disgorgement. Later cases have. They're simply under the Exchange Act 78 U TE or U2E and U3E notes that the SEC has the authority to order requiring accounting and disgorgement, including reasonable interest, as part of its administrative or cease and desist proceedings. And so we have kind of case law that's developed out of that, and there's a large body of case law that characterizes disgorgement as an equitable remedy. One thing that this CCA is that I find interesting in connection with the CCA is that it raises the prospect that while disgorgement could be equitable, depending on how it's applied, it may not be, at least for tax purposes. And so I do know that in kind of negotiations, when we've represented companies, I mean, at times, the government will allege an amount in profits that have been made, and companies may disagree with that, and there may be negotiations. And so it could be that, a company feels that in a particular situation that the disgorgement sought was punitive in nature. One interesting aspect to this all is that if you find that if you hold equitable, so if you look at this issue and you determine that that disgorgement or taxes paid on illicit profits cannot be deducted, it kind of suggests that it is more punitive in nature. So it could be kind of a chicken and the egg question, that if you don't allow disgorgement, it makes this appear as though it's more punitive if you don't allow deductions. If deductions are allowed, go ahead.
It becomes a self-fulfilling prophecy.
Exactly.
Because if there's a concept in the tax law that if you had paid tax on income in a prior year and you return it, you can have deductions in that subsequent year, but you have to be able to show first that you're entitled to a deduction in that subsequent year, and then there's a formula for equalizing the value of that subsequent year deduction with the burden, the tax burden that was imposed in the first year. But if you can't deduct it in the first instance because it's a fine or a penalty in year 3, 4, 5, then you don't even get the ability to trigger these other rules that try to equalize the deduction with the earlier burden. And so it becomes, in essence, a double whammy.
George, that really leads into the next area I wanted to explore with you, because in your client memorandum, you indicated that the CCA was notable for several reasons. These reasons included that the CCA reflected a movement by the IRS to more aggressively challenge deductions of disgorgement payments in FCPA cases. Second, that a potential inconsistency in how the IRS and the SEC viewed disgorgement. You did talk about this issue of, or raise the issue of prejudgment interest, whether or not that was deductible, and whether or not if disgorgement of profits on which the company may have already paid taxes would not be deductible going forward. Could you really kind of explain those and go a little bit into the weeds on what your thoughts were?
Sure. I'll take the first one in terms of, well, what does this particular document portend with respect to further IRS activity in the area? And the IRS is a big organization. It has audit teams spread throughout the country, and it has, at different points in time, tried to coordinate issues at a national level. In some eras of the government, they just let individual audit teams make their own decisions and be autonomous, and that led to disparity about taxpayers being treated more harshly in some areas and more leniently in others. And so there's been, in the last decade and a half, more of a movement to sort of consistency across the board, which meant they have sort of centralized coordinators of particular issues, and they cast the current incarnation of this coordination as issue campaigns. And the fact that this CCA is emanating up was issued combined with the fact that FCPA payments on I will refrain from calling them fines and penalties. So payments made pursuant to or in connection with an enforcement action for an FCPA violation are becoming more common. you wonder whether the IRS this is the start of a coordinated effort to find out who is making payments under to resolve FCPA cases, and then are they going to examine each of those payments and go out and find those taxpayers and audit those taxpayers. People make their name within the service and move up the hierarchy, by identifying issues and coming up with government positions, and then scouring the country to find taxpayers for which they can bring, a proposed adjustment against. So there's nothing in this document itself that reflects a organized campaign, but the fact that an issue rose to the level of a CCA, got the attention of somebody at the national office, and it gets published and is now sort of known within others within the government, you wonder to what extent the government will now make an active effort, especially given the government favorable response in the CCA.
And then how about this potential inconsistency between the SEC and IRS? Is that something unusual between government agencies on this type of issue?
I think so. It's and Marc and I have talked about this too. You don't want to. It's a push and a pull, right? I think from a tax perspective, the more I can call disgorgement equitable, I get an advantage. But I understand from an FCPA perspective, there are disadvantages to calling something equitable. It's primarily statute of limitations issues, and I can let Marc talk about that. But my understanding is that the SEC would like this to be equitable. So if the SEC is taking one view and the IRS is taking a different view, will the taxpayers just be caught in the middle and hit on both sides, or can if whichever view is sort of more important, have one agency prevail on the other? If it's important for disgorgement to not be an equitable penalty, and for FCPA reasons we're okay calling it punitive, then you get an advantage there, but then you risk agreeing that the payments will be non-deductible. If instead you want to prevail on the IRS that the disgorgement is equitable, can you get the SEC on your side to convince the IRS that no, this is not punitive, this is equitable, this should be deductible, and not trigger the prohibitions under 162F? Whether the SEC would do something sort of unilaterally and just sort of approaching the IRS, or if taxpayers in negotiating resolutions of FCPA cases can get the SEC in the documentation to say things along the lines of, this amount of disgorgement is utilization of an equitable remedy available to the SEC and does not reflect any punitive action taken on the part of the government. If the SEC were to comment on the deduction itself, if the SEC were to say this is not a fine or penalty under Section 162F of the Internal Revenue Code, the IRS typically ignores those statements. The IRS will say, we tell you what 162F means, you can't tell us what it means. But they will defer to the agency in how they characterize what it is that the agency itself is doing. So if the agency were to say in whatever documentation resolving an agreement that this is a non-punitive, equitable remedy available to the SEC, then that could go a long way to helping taxpayers on the deduction side. It may have implications for how people view the resolution of the FCPA side, though.
One nuance to what George notes is the catch-22 that he notes is that from an FCPA perspective, companies caught in FCPA actions may kind of have different opinions on where they would like the chips to lay as opposed to a general defendant in the United States, in that a lot of companies that are targets of FCPA actions, there's a number of foreign companies and there's a number of large U.S. companies who may or may not be consolidating their earnings here abroad and may or may not have been paying taxes domestically on those earnings to begin with. So, I can let George sound in on what the implications of that would be, but the statute of limitations implications of finding disgorgement not to be equitable could be more advantageous to them, limiting the SEC's reach in this area and ability to claw back allegedly illicit gains that date back beyond the 5-year period.
Right, and I don't want to necessarily prejudge how the community would rather view this, but it is sort of a push and pull that people need to think about, because there would be advantages on the tax side to calling it an equitable, non-punitive amount, but then disadvantages on the FCPA side.
And then, George, we've got a third notation, or a third kind of a reason for notability, and that's on the issue of whether prejudgment interest is deductible. And that's certainly a big part of the financial penalties levied by the SEC. And does this CCA give you any comfort one way or another as to whether or not prejudgment interest is deductible?
Well, it doesn't give me any comfort, and it gives me a little anxiety, but only because it's not mentioned. Interest is interest, and interest should be deductible no matter what. But the way that this is couched, and the fact that they didn't, even though there's prejudgment interest referenced in the fact section, they don't comment about the deductibility of the prejudgment interest, it makes you worry that will they paint with a broad brush and say, well, if it's disgorgement and disgorgement's punitive, then the prejudgment interest is just an additional penalty in lines with the sanction, the punitive sanction that the disgorgement is, and then use 162F to override what would ordinarily be just a standard interest deduction. It would have been nice if they had said, you know, the disgorgement piece is non-deductible, but interest is ordinarily deductible and they get a deduction for their prejudgment interest. I think for the most part, people have not viewed the interest component as at issue, that the deduction was available for prejudgment interest. But the CCA's silence gives you a little bit of anxiety in that area.
So, George, with regard to clients or companies that may be facing this question going forward, it seems like one of the clear concepts or clear takeaways from this is it really is a case-by-case analysis at this point, heavily involved in the facts of each case. Marc has hinted at some of the implications that it may mean for companies in the way they think through this. Is how does a company, or how would someone really try to get a definitive answer on this? Is there a mechanism that they could go to the IRS and ask for an opinion, or is it simply you have to take your best shot and then see what the service opines afterwards?
Yeah, that's a multi-layered strategic question, and there are programs where you can go in and get the IRS to comment and conclude what the tax treatment is even before you file your return. You know, you can go in for a ruling in advance, and they also have what's called a pre-filing agreement, where before you filed your return, you tell them all the facts and how you expect to report it, and if you reach agreement, then the issue's over. But the problem with a lot of those issues is you are affirmatively raising your hand and telling the IRS, you know, come look at me, come look at me, come look at me. And you have to weigh to what extent you want to affirmatively approach the IRS to get that comfort with the prospect of the IRS coming in and auditing you. If you're a company that's under constant audit and you know that the IRS is looking at all kinds of issues, well, then you're more likely to raise your hand and bring the issue to their attention. If you're a company that's not currently under audit, doesn't have prospects for being audited anytime soon, then you wonder to what extent you want to raise your hand. You do have to live with, 3+ years of uncertainty as to whether they're going to agree with your return filing position. But that's kind of a strategic decision that each taxpayer can make for their own. In terms of best preparing your case, These are fact-specific cases, so when you're interacting with the government in reaching a resolution of it, you have some control over how those facts unfold and are presented. And generally speaking, when you get audited, a taxpayer is the one who marshals the facts and has access to the facts, so you have an inherent advantage over the government. They have to ask questions and probe in order to find the facts, whereas you can take what are the favorable facts and package them nicely and turn them over to the government with a bow. But thinking about that, when you're interacting with the SEC or DOJ, you can try to work with them in terms of having correspondence back and forth as to what the two sides are viewing in terms of what is being resolved, what is the intent of the parties with respect to these different pieces. There's usually a piece there, or I shouldn't say there's usually, there may well be a piece that is clearly a fine, and you can separate that from everything else and say, here's the amount of fine, and then here's the amount of disgorgement. If you want to avoid using the word disgorgement, maybe you can get them to say that it is restitution. That would certainly be beneficial. And if you can also show that the restitution is going directly to some aggrieved party, that's even better. And so you can try to lay out in the interactions with the government what might be favorable facts to help support the deduction when the IRS ultimately comes knocking on your door, or you affirmatively bring it to the government yourself.
Marc, if I could turn to you now, you have alluded to some of the decisions that the sort of the lawyer end of this equation may need to make in terms of whether it should be characterized as profit disgorgement, restitution, or perhaps other. And that really brings me to the second general topic I wanted to visit with you both about, which is a recent 11th Circuit Court of Appeals in SEC versus Graham that limited the 5 years or set the 5-year statute of limitations, applied it to the SEC for claims of profit disgorgement or declaratory relief. So with that introduction, could I maybe turn it over to you to explain what Graham is, what you see as the significance, and how it plays into this discussion we've had on tax treatment?
Sure. So Graham involves a case. It percolated up in the 11th Circuit, and the question revolved around whether Graham and several other defendants who were allegedly selling condominiums that functioned as unregistered securities were in violation of federal securities laws. And in connection with that case, the SEC or Graham fought the charges there, arguing that the SEC's complaint was time barred because the SEC had sought to impose disgorgement among other things. They also enjoined the defendants from violating securities laws in the future, and ordered them to repatriate funds and pay civil penalties. And the court found that the payment of any civil fine would constitute under U.S. 28 U.S.C. 2462. That establishes the statute of limitations, a 5-year statute of limitations for any civil fine, penalty, or forfeiture within that is commenced within 5 years of the date when the claim first accrued. The question that percolated to the 11th Circuit was whether an injunction constituted a penalty, fine, or forfeiture, and whether disgorgement constituted penalty, fine, or forfeiture. And the court found that injunctions are equitable relief and or could be equitable relief and are not subject to the statute of limitations. But in terms of the declaratory judgment and the disgorgement, they reasoned that they sidestepped the issue of whether disgorgement was a penalty or equitable or non-equitable, but instead looked at disgorgement in terms of whether it was akin to a forfeiture. And they said because they found disgorgement to essentially there to be no meaningful difference in the definitions between disgorgement and forfeiture, they found that it was barred by the 5-year statute of limitations, the imposition of this disgorgement in this case. and sidestep the issue of whether it was a quote-unquote penalty or not. The interesting thing about Graham is it creates a circuit split. Prior circuits have avoided or have found disgorgement to be equitable. The DC and Ninth Circuits in particular have sounded on this issue, and they've not done this forfeiture analysis, but instead determined that disgorgement is not limited by the statute of limitations because it is equitable in nature. And so we have a circuit split. It's going to be interesting to see how the SEC responds. They're almost certain to fight this tooth and nail. I think there are officials on record as characterizing this as questionable law, and whether or not the Supreme Court agrees to take this case now or allow the issue to continue percolating will be interesting to see. But the SEC is definitely going to fight this because it creates a range of issues, some of which circle back to the disgorgement issues we've been discussing, because even though in this instance we're talking about whether it's punitive or not, equitable or not in the context of statute of limitations, if the court finds that it is punitive or based on the reading of the SEC case, one could interpret that even though the court sidestepped the issue, the court would be disposed to find this as a penalty and also barred by the statute of limitations. So the implications are broader than just statute of limitations. They speak to whether these disgorged amounts can be deducted under taxes, among other issues. So it'll be interesting to see how this proceeds.
Very interesting, and really an important case. I guess I had focused on the pressure that I would have thought the SEC was under to resolve enforcement actions more quickly. As we both know, 5 years is not unusual for the pendency of an enforcement action, and I think we saw an example of that just this week or last week with the analogic SEC enforcement action. But now, and really with your both of your explanations, I can see how the Graham decision together with the circuit splits could really lead to a lot of open questions, both for folks on our side of the fence who may be defending companies, and even in the government's eyes on how to characterize facts, what penalties to suggest or propose, what penalties to agree to, the time frames for all of those, your internal investigation, how early do you if you self-disclose, and how long does it take you to complete your internal investigation after you self-disclose, particularly if you're a multinational in 100 or so countries. Some very interesting questions out of all of this, Marc.
Yeah, definitely. And what kind of adds to the nuance here is that the SEC and DOJ's practice of requesting statute of limitation waivers in many of these cases. And so I think if a company understands that the SEC may not be able to disgorge amounts as it has previously stated it can do beyond the 5-year statute of limitations, it may kind of up the leverage in negotiations in connection with waivers and in connection with settlement agreements. I do think in representing companies that are under investigation by both the SEC and DOJ, you do see a difference in how the DOJ conducts itself, in that it understands itself to be more limited by the statute of limitations in these cases, where the SEC is typically kind of seen itself as having a broader hand. There are some additional nuances, particularly with the disgorgement issue that we're talking about, as you begin to see Graham and its characterization of disgorgement as forfeiture. There's a recent Federal Circuit opinion that George could probably add a better explanation to, but Nacho versus the United States, and an individual in that case was convicted of insider trading in order to forfeit his profits to the government, and the Federal Circuit held that profits could not be deducted in that case as a business expense under Section 162 as forfeiture, and so you combine that Federal Circuit opinion with the Graham opinion, and it circles back to, even if you're calling disgorgement forfeiture, still may not be deductible in the Federal Circuit's eyes. And there's also additional cases that are percolating up. There's a DC Circuit case, not specifically tax focused, but Timbervest versus SEC, in which the company was ordered to pay disgorgement pursuant to SEC order, and they had proactively gone and returned the allegedly illicit profits to the party that was allegedly wrong, AT&T in that case, and then sought to moot the SEC order as a result. And the DC Circuit's still hearing that. Whether they remand that to the SEC's administrative proceeding or whether they take a position on it will be interesting, because that case kind of revolves around whether the disgorgement is going to be viewed as mooted by the fact that they, on their own, entered into this restitution, and whether the disgorgement could still stand, and in that case, would it be seen as more punitive or not?
Gentlemen, unfortunately, we are near the end of our time, so I'm going to have to sadly end this, but I wanted to first of all, thank you both. There are two documents we've referred to throughout this podcast. One is a Miller International and Tax Alert entitled Profit Disgorgement in FCPA Cases, Deductions for Tax Purposes. It's dated June 1, 2016. I assume it's available on the Miller website. The second is a blog post by Marc in the FCPA blog of June 8, entitled 11th Circuit Ties SEC Disgorgement to 5-Year Statute of Limitations. And gentlemen, I wanted to ask if anyone wanted to get in touch with you all to follow up on any of these matters. Could they email you? And if so, how would they do it?
That would be perfectly fine. This is George. You can always find me on the Miller and Chevailer website. But my email is ghani, G-H-A-N-I, at milchev.com, M-I-L-C-H-E-V as in victory.com.
As well, my profile is available on our website. Folks are happy. I'm happy to have folks reach directly out to me. My email is mbohn@milchev.com as well.
George Hani, Marc Bohn, thank you both very much. This has been a fascinating discussion, and I look forward to the next round of U.S. government pronouncements, whether they come from the SEC, the federal courts, or the Internal Revenue Service, and perhaps we can continue the conversation.
We'll be happy to, Tom. Thank you for having us.
Hello, everyone. This is Tom Fox again. I'd like to thank you for listening to this episode of the FCPA Compliance and Ethics Report. I referred extensively throughout the presentation to two documents created by the lawyers involved in this case. The first one was a blog post by Marc Bohn, 11th Circuit Ties SEC Disgorgement to 5-Year Statute of Limitations. This was found on the FCPA blog. The second was a Miller and Chevailer client alert entitled Disgorgement of Profits in FCPA Cases, Deductions for Tax Purposes. I'm going to have both of these on my show notes so you can download and take a look at them. I would appreciate if you would rate this podcast in iTunes if you're listening to this in iTunes. And if not, if you have some questions you'd like me to take a look at in my next question bag, mailbag episode, please email them to me at tfox@tfoxlaw.com. This is Tom Fox. Thank you very much for listening, and I look forward to visiting with you again.